So my objective whenever I encounter any stocks is to, as quickly as possible, reject the idea so I can get back to general reading. So the model is not to find investments. The model is to find the flimsiest reason to say no. And as soon as I get to the first reason, I'm done and I move on. And usually, two things work pretty well for getting rid of stocks really fast. The first is circle of competence. You encounter, like, I mean, if I look at some pharma company or something, it's gone. I mean, I don't even need to look beyond the name. It's gone. Um, and the second is that if I think I have some understanding of the business, then the second is I look at very quickly the market cap, earnings, just some metrics on valuation, and I'm talking about less than 60 seconds. Um, and once I see that it's not at a PE of one, it's gone as well. So basically, we want to, or at least I want to get rid of investment ideas for the flimsiest reasons as quickly as possible. And let's say some stock is really cheap. It appears to be within my circle of competence. Uh, then for 1 minute, I'll go to 5 minutes. I'll give it 5 minutes. And again, to find something where I can just get rid of it. And if I cannot get rid of it in 5 minutes, then I'll give it 15 minutes. And all these exercises are designed to get rid of the stock as soon as possible. And the inversion of that is that I'm only looking for, if I can find 2 or 3 ideas in a year, I'm done. And I mean, I think in daily emails, which I get in my folder, I think on a typical day, there are like at least 3 or 4 stock tips in that folder. And within the 900 seconds of processing the folder is those 4 stock tips. Each of them gets, 15 seconds because I just look at the company, I look at the price, and I very quickly try to see, okay, what is this guy saying is the money we're going to make on it? And, a lot of times the stocks I get, it's trading at 10 and it's worth 13. And then, there's a 40-page write-up explaining why it's 13. Well, once I see it's worth 10, I say, okay, I'm going to give this human full benefit of doubt. I'll accept that it's worth 13. And he didn't say it's worth 60 with it trading at 10. So we're done. Move on. And so that's how, so basically, be a very harsh grader on stocks. And the second thing about this business is, you guys don't play baseball, but I think maybe you're familiar enough with the game that Buffett says in investing, there are no called strikes. So, baseball, 3 strikes, you're out. In investing, you can let 1,000 balls go by, 10,000 balls go by. You can let 95% of great investment ideas go by, and it doesn't matter. So there's always more balls being pitched at you. And so if in a year you can find 3 of them, and even after finding 3 of them, if one of them is you're wrong on one of them, like one of the commandments says, that's just par for the course. It doesn't matter. If you're right 2 out of 3 times, you'll be quite wealthy. And the scuttlebutt or the amount of time it takes or the due diligence to get comfortable with the investment, that varies quite widely. I mean, it's been as short as 3 hours from the time I first ever heard about a company to the time I started buying it, to 3 months, where, like I think when we made the investment in Fiat Chrysler in 2012, I hated that industry so much. I kept trying to find reasons not to invest. And after 3 months of digging, I capitulated and bought it. And it's been an 8x since then. So basically, the thing is, it varies. It just depends on the business. The good thing is that if you run a concentrated portfolio, and if you're going to make 2 or 3 investments in a year, you have more than enough time, especially if you're quick to say no and you don't spend time with other humans. you have more than enough time to basically do all the research you want to, um, you know, even kick the tires as you want to, and so on. So uh, that's the Buffett model, and so I think many of the things you'll hear or you'll see with the way I operate. First of all of these were copied from Warren, so I didn't come up with any of these. But it is not the way the industry operates. And in my opinion, the industry operates stupidly. Um, and and so many things, no team, no management fees, um, doing all your own work, concentrated portfolios, all of these things. This is the path to nirvana, and that's what you want to be getting to, and that's what you want to be doing. If we had a perfect crystal ball, and which told us what the risk-free rate of return is going to be for the next 20 years, then that would give you a basis to come up with a discount rate. That would be the right way to do it. But we don't have crystal balls that tell us that. And Charlie Munger also says that he's never ever seen Warren do a discounted cash flow. I already told you, thou shalt not use Excel. I know that in your time at LBS, you have never turned on Excel, and I'm so proud of you. Uh, so the thing is that we are not really going to fixate on stupid things like discount rates. Uh, what we want is obvious no-brainers hitting us over the head with, in the US, what we would call a 2x4. Something you'd buy at Home Depot. Um, so basically, when I was looking at, let's say, Fiat Chrysler in 2012, I've never run a DCF. I mean, I think DCFs are, for the birds. I mean, the market cap of the company was 5 billion, and I thought in maybe 5-6 years they'd make 5 billion a year. And I said, okay, why don't we just buy the company and hold it for 5 years, and let's see what Mr. Market will price this business at when it's making 5 billion a year. I'd really like to see it being priced at 5 billion then, and be the cheapest stock on the planet. And so that was the extent of the DCF that was done. And so basically what we're looking for is we're looking for very obvious no-brainers, wildly mispriced, severely undervalued opportunities. That's what we're looking for. And we want to be harsh graders and say no to everything else.